Infinite banking. Smart strategy or expensive trap? There's a strategy going viral right now that promises you can ditch the banks, become your own banker, and build serious wealth using nothing but a life insurance policy. It's called infinite banking. For some people, it might be the smartest financial move they'll ever make. For others, it can become a trap that costs them hundreds of thousands of dollars. The people selling it call it a wealth cheat code. The critics call it a scam. The only way to know the truth is to run the actual numbers. Today, we're going to follow one ordinary person through this strategy, dollar by dollar, year by year. By the end, you'll know exactly whether infinite banking can work for you, or whether it's mainly making someone else very rich. Meet Ethan. He's 30 years old and earns about $70,000 a year. He's been doing the responsible thing, contributing to his 401k, keeping some money in savings, and trying to build real wealth. One night while scrolling, he sees a well-dressed guy standing in front of a whiteboard explaining how wealthy families have used whole life insurance for generations to build tax-free fortunes. The video has millions of views. The pitch is powerful. Unlike term life insurance, which only pays out if you die, whole life insurance has a savings component called cash value. Over time, money builds up inside the policy. The big hook? You can borrow against that cash value anytime you want. Need a car? Borrow from your policy? Want to invest in real estate? Borrow from your policy? Instead of paying interest to a bank, you pay it back to yourself. Become your own banker. It sounds like you've been leaving money on the table your whole life. Ethan gets excited. He watches dozens more videos. Everyone says the same thing. This is how the rich build wealth, the strategy they don't teach in school, okay? So he contacts an insurance agent who specializes in infinite banking. The agent is polished and confident, and shows Ethan an illustration with cash value growing steadily year after year. Ethan is ready to sign. But before he does, let's slow down and look at what's really happening. When you pay your monthly premium, the money doesn't all go into your cash value. It gets split. Part covers the actual death benefit, part pays the insurance company's operating costs and overhead, and whatever is left goes into your cash value. In the early years, that cash value grows very slowly. A big reason? Agent commissions. Agents often earn 70% to 110% of your entire first-year premium as commission. That means in year one, the agent can make more than you actually put in. This is why your cash value barely moves at the beginning. It's by design. Infinite banking practitioners know this, so they optimize the policy with something called paid-up additions, PUAs. These are extra payments that go almost entirely into cash value, speeding up growth significantly. The policy also earns dividends from the insurance company, currently around 5.75% to 6.6% from the best mutual companies, though not guaranteed. The money does grow slowly at first, then faster with compounding. When you need money, you don't withdraw it. You take a policy loan using your cash value as collateral. Your money stays inside the policy, still earning dividends. On paper, it looks amazing. Your money works in two places at once, tax-free, private, with repayment terms you control. But here's where most YouTube videos stop. Let's run Ethan's real numbers. He decides to commit $750 per month, $9,000 per year. For someone earning $70,000, that's roughly 13% of his gross income. The agent designs an optimized whole life policy with a base premium plus maximum PUAs. Year 1. Ethan pays in $9,000. Cash value? About $6,300 to $7,200. He's immediately down 20 to 30%. Year 3. Total paid $27,000. Cash value around $22,000 to $24,000. Still underwater. Year 5 to 7. After paying $45,000, $63,000, the cash value finally breaks even. From here, nearly every new dollar goes straight into cash value, and dividends start adding meaningful growth. Year 10. Paid in $90,000. Cash value. Roughly $85,000, $100,000. Year 20. Paid in $180,000. Cash value $210,000. $260,000. Year 30. Paid in $270,000. Cash value could reach $400,000, $500,000 or more, plus a growing death benefit. Those numbers sound decent. But what if Ethan had used that same $750 a month differently? Alternative plan. Buy a 20-year term life policy for about $30 a month, $500,000 death benefit protection for his family. Then invest the remaining $720 a month into a low-cost S&P 500 index fund. We'll use a conservative 8% annual return. Historical average is closer to 10%. After 10 years, invested $86,400. Portfolio worth roughly $130,000, $135,000. Versus $85,000, $100,000 in whole life. After 20 years, invested $172,800. Portfolio worth $430,000, $450,000 versus $210,000, $260,000. After 30 years, invested $259,200. Portfolio worth $1.05 million to $1.1 million versus $400,000, $500,000 in whole life. Same money, same time period. One path ends at about $500,000. The other exceeds $1 million. The difference is massive. Whole life advocates will argue the cash value is guaranteed and tax-free, while stocks are volatile and taxable. They're right, those are real advantages. The peace of mind of never seeing your balance drop has value. But even after paying long-term capital gains taxes, usually 15%, the index fund route still comes out far ahead. And if part of the money is in a Roth IRA, the growth is completely tax-free. There's also flexibility. With an index fund, Ethan can access money in days with no loan, no interest, and no repayment schedule. With whole life, he borrows his own money and pays 5 to 6% interest. Here are the important points the sales pitches usually leave out. 1. High commissions. On a $9,000 annual premium, the agent can earn $6,300, $9,900 in the first year alone. This is the main reason cash value grows so slowly early on. 2. Policy loan interest. You pay 5 to 6% interest on loans, which largely cancels out the dividend growth. You're not getting free money. You're paying for access. 3. High lapse rates. Industry data shows most whole life policies lapse around year 7 or 8. Many people never reach the point where the policy performs well. When life happens, they surrender the policy and often walk away with less than they put in. 4. Opportunity cost. Every dollar going into whole life can't go into a 401k match. Roth IRA or low-cost index funds places with much higher long-term growth potential at Ethan's income level. So, does infinite banking work for anyone? Yes, but probably not for the people being heavily targeted on social media. It can be a powerful tool if you're already earning $250,000 plus per year. You've maxed out your 401k and Roth IRA, and you still have surplus cash. At that level, the premium is a small percentage of income. You've already captured all the easy tax-advantaged wins, and whole life becomes useful for extra tax-efficient storage, estate planning, and business liquidity. For high net worth families, it's excellent for passing wealth tax-free to heirs and reducing estate taxes. The strategy is real and has been used by wealthy families and business owners for over a century. The mistake is marketing a rich person's optimization tool as an everyday wealth-building foundation. The real question isn't whether infinite banking works. It does. The question is, does it work for you right now, at your current income and financial stage? For most people earning $50,000, $100,000, the honest answer is, not yet. So what should Ethan actually do with his $750 a month? Step 1. Buy a 20-year term life policy, $500,000 coverage for Tilda. $28, $35 month. Family protected. Step 2. Contribute enough to his 401k to get the full employer match free money that no strategy can beat. Step 4. Invest the rest in a low-cost S&P 500 index fund. Keep it simple, keep fees low, and let compounding work over decades. If Ethan follows this from age 30 to 60, he'll be in a very strong financial position. Once his income grows significantly, maybe to $200,000 or $300,000, he can revisit whole life as an addition to an already solid foundation. Infinite banking is not a scam. The product is legitimate and time-tested. For the right person, in the right situation, it can be a smart strategy. But the way it's being sold as a universal wealth hack for everyone simply doesn't match the math for average earners. Your money has better, cheaper, and more flexible places to grow. The most important financial decision you can make is knowing the difference between a strategy that's right for you and one that's right for someone else's commission check. Do the math. Make the decision that fits your reality, not someone else's sales pitch.